Today, we're diving into something that sounds complicated, but I promise, by the end of this video, you'll understand it clearly. We're talking about options in the stock market. An option is a financial contract that gives you the right, but not the obligation, to buy or sell a stock at a specific price before a specific date. There are two types of options, call options and put options, more on those in a second. But first, let's look at some key terms. Pushpin Term 1, Expiration Date. Every option has an expiration date. This is the last day the option is valid. After this date, the option becomes worthless if not exercised. For example, if an option expires on August 16th, you must decide to use it, or not, before that day. Pushpin Term 2, Strike Price. The strike price is the price at which you can buy or sell the stock, according to the option contract. Let's say you have a call option with a strike price of $100. That means you can buy the stock at $100, even if it's trading at $120 in the market. Pushpin Term 3, Premium. When you buy an option, you pay something called a premium. This is the price of the option itself. Think of it like a ticket. You pay for the possibility of buying or selling the stock, but you're not required to. You've just learned the key terms in options. Now let's move on to the two foundational types of options. Firstly, upward trend call option. A call option gives you the right to buy a stock at a certain price before the expiration date. You buy calls if you think the stock is going up. For example, you buy a call with a $50 strike price. If the stock rises to $70, you can buy it for $50 and you make a profit. Next, downward trend put option. A put option gives you the right to sell a stock at a certain price. You buy puts if you think the stock is going down. For instance, you buy a put with a $50 strike price. If the stock drops to $30, you can still sell it for $50. Now let's flip the script. What if you sell options? When you sell a call, you're giving someone else the right to buy your stock at the strike price. This is called a covered call if you already own the stock. You get paid a premium, but if the stock goes up a lot, you might be forced to sell it at a lower price. For instance, you own 100 shares of AAPL, currently trading at $200, there is total value of $20,000. You sell one call contract, each equals 100 shares, at strike price, $210, expiration 1 month from now. Premium, $2.50 per share. Right pointing arrow. You receive $250 upfront. Anti-clockwise arrows. What happens at expiration? Upward trend scenario 1, AAPL closes below $210. The call option expires worthless, and you keep your 100 shares. You keep the $250 premium as profit. You can sell another call next month. Repeat. Rocket scenario 2, AAPL closes above $210. You are obligated to sell your 100 shares at $210. Capital gain, $10 per share times 100 equals $1,000. Plus premium, $250. Total profit will be $1,250. But, you miss out on any gains above $210. Light bulb sell put, cash secured put. When you sell a put, you're agreeing to buy a stock at the strike price if the buyer wants to sell it. You earn a premium up front. This is often used to buy stocks at a discount, but you must be ready to buy the stock if it drops. For example, AAPL is trading at $200 and you sell one put option with strike price of $190 and expiration in 1 month. Collect premium, $3 per share equals $300 per contract. You set aside $19,000 in cash to cover buying 100 shares at $190, cash secured. Anti-clockwise arrows. What can happen at expiration? Downward trend scenario 1, AAPL falls below $190. You are assigned and must buy 100 shares at $190. You paid $19,000, but you also keep the $300 premium. Effective purchase price equals $190 to $3 equals $187 per share. Check mark. You bought AAPL at a discount, and you now own 100 shares. Upward trend scenario 2, AAPL stays above $190. The put expires worthless and you keep the full $300 premium. You do not buy the shares and you can repeat the trade next month. Options can be powerful, but they also carry risk, sometimes more risk than buying regular stocks. Let's break it down. Check mark. If you buy options, the most you can lose is the premium you paid. Warning. If you sell options, your risk can be much higher. Selling a naked call, without owning the stock, exposes you to unlimited loss if the stock skyrockets. Selling a put can lead to big losses if the stock crashes, because you might be forced to buy it at a much higher price than it's worth. Always understand what you're risking before you trade. Options are like power tools, super effective if used right, but dangerous if used carelessly. They can boost your returns, protect your investments, or generate extra income, but you need to understand the mechanics and the risk. If you're just starting out, consider learning with a paper trading account or consulting with a financial advisor before diving in. If this video helped you understand options better, smash that like button and share it with a friend. Have questions? Drop them in the comments and I'll answer them. And don't forget to subscribe for more investing education, tutorials, and strategy breakdowns. Thanks for watching, and I'll see you in the next one.